Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Ted Dixon, CEO and co-founder of IncResearch.ca. He invented the Inc. Canadian Insider Index, which is used by the Horizons Canadian Insider Index ETF, a 2017 and 2018 Fund Data Fund Grade A Plus Award winner. His website, CanadianInsider.com. Welcome back to the show, Ted.
Well, thanks for having me back, Jim.
Ted, why is a breakout in Canadian financial stocks important for junior oil and gas?
Well, on July 17th, we put out a report, and there's actually a video summary on CanadianInsider.com that your listeners can go to and look at. It's only 90 seconds, so it's pretty short. But essentially, we looked at a number of small cap stocks in Canadian oil patch, and one of them is in the Canadian Insider Index, Yangara Resources. Now, it's been growing its production, growing its earnings, but the stock keeps falling. And part of that has to be due to investor pessimism with respect to the future and the outlook on the Canadian oil patch and the oil price in general. So until some optimism comes back, and where you've got investors looking to participate in smaller names that have leverage to better times ahead, these stocks are going to continue to struggle, it seems. Everyone's in a gloomy mood. So what could give us a bit of a heads up that the gloom is starting to give way to a little bit more sunnier days? Well, if the financials can start to trend upwards, they'd be picking up more activity in terms of lending, more activity in terms of confidence in people being able to pay back their debts. It would be a sign that investors have more confidence in the overall economy, and especially if it's driven by higher long-term bond yields. And why that's important is if investors believe there's going to be more inflation, there's going to be more economic activity, they're going to want higher interest rates when they lend money, and that's always good for banks because as interest rates go up, they can usually charge you and me more. They can sneak in a price increase and build their margins. So we would need to see some of these middle-sized, smaller-sized banks and financial stocks pick up some steam, because that would indicate that investors are a little bit more optimistic about the global economy. And why is that important for oil and gas? Well, that they are the most economy-sensitive group in the market. So if we have better signs from the financials that there's a stronger economy, this should ultimately help the smaller cap stocks. But we're not there yet. We're looking at a couple of sort of the middle size financials. We've talked about in our morning reports. We've talked about one of the smaller banks here in Canada, Canadian Western Bank. And it's in the oil patch. It's a smaller bank. Now it's struggling to try and take it over its 200-day moving average. If it can break the 200-day moving average on the upside, then that would be a positive sign. We're not there yet, but we've seen some insider buying, so that's pretty good. So there's that's why we're watching it. We're like, can this stock kind of get on the upswing here, start to get in a long-term upward trend? So we're watching it very closely. And we sent a report out earlier this week to our subscribers on that. And a week ago, on July 9th, and there's a summary on this on the Canadian Insider site, we're also looking at an asset manager called AGF Management. There's a lot of mutual funds, very big players in the market. before the financial crisis. I mean, they're still a big player, but a lot more competition's come in, and so they've had a tough go of it. But they're also close to their 200-day moving average, moving on the upside. And what would help them, there's a lot of things that could help an asset manager, but one thing that helps an asset manager is the stock market going up, because there's two ways for asset managers to make money. Jim, you and I give them more money to manage and they charge us, or the market goes up and then they have more money to manage because the value of the assets they're managing goes up. So if AGF management can start moving up, a stock like that, along with Canadian Western Bank, and probably a few others will add to the list over the next few weeks. If they can start moving on the 200-day, above their 200-day, and they're almost there, they're trying, then that could finally give a bit of a green light to start looking at these beat up, lagging, smaller cap oil and gas names that have really had a tough go. I mean, there's a whole group of them that have just, no matter what they do, people just sell them. So it's really been a tough time for these small cap oil and gas names for the most part.
We'll have more with Ted Dixon right after this.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Ted Dixon. Ted, Ray Dalio has jolted the gold market out of its summer doldrums. What happened?
Yeah, that was a bit of a surprise. We were just putting together our July top 20 gold report, and out came this piece by Ray Dalio talking about a paradigm shift. So we kind of played on that in our title for our top 20 report. We call it the Dalio shift, where, he's basically forecasting that we're about to go into a new era here, a decade or so period, where essentially bond investors are going to get smoked, or at least if not smoked, certainly they're going to probably at big risk of losing some money. And on the flip side of that, he likes the gold group, because he believes that central banks and governments are going to do everything they can to debase the currencies, or fiat currencies, in order to pay off all these debts that have been amassed, both public and private, and that there really won't be a choice. So it's something he's talked about before, but the very interesting part about this piece that he put out, and we have a link to it in the top 20 report, but it's also available on LinkedIn. You can probably search it there. But the only asset he really talked about favorably in this new paradigm, which he doesn't predict when it's going to happen, he just says probably in a few years, is gold. That's the only one he really kind of pointed to. And when you kind of read between the lines of what he was saying about equities, and in my view, he was basically saying, well, it all depends on politics on equities. People don't like to talk about politics in investing because you've got different views, but I think as an investor you have to take the cards that are being dealt. So we don't know exactly what's going to happen in the U.S. presidential election, but it's going to be a big one, because really we still don't know who the Democratic candidate is. I mean, if you got a Joe Biden, well, then that would be sort of the Hillary, the mainstream against Trump, which in that case, it wouldn't be so bad for stocks, because the worst case scenario, you might get Joe Biden. Well, he's probably not going to do too much that's going to, to shake up things. But if you had Elizabeth Warren on the ticket and she ended up surprising and beating Trump, well, you have a candidate who's actually already running against Wall Street. Now she might, that's to get the primary. I mean, she might pull in her horns a bit, but that's not the Trump formula. And some of these players on the left have seen how Trump made it work, and wouldn't surprise me if they tried to out Trump him on the left. So we'll have to see how this plays out. So politics is going to have, I think, a big impact in terms of the potential for the U.S. stock market, anyways, in this new paradigm that Ray Dalio is talking about. Now, we're not there yet, and we're certainly, we don't know who's going to be on the Democratic ticket and whether the Democrats have a hope against Trump. So this will all play out in the next year or so. But as that plays out, I think we'll see some impact in the U.S. market as investors either get really confident that Trump is going to win again, and which I think as whether you like him or not, for the U.S. market, he's probably their best bet. And or if Biden wins it looks like he's going to win the nomination for the Democrats, then we'd also have equity markets in the U.S. breathing a sigh of relief. So, I mean, that's my take on sort of in between the lines of what Dalio was saying. But unequivocally, he was bullish on gold because, and for one thing, he believes the world is underweight gold. Other people, money managers, people who really get paid to invest your money, my money, but don't have a lot of skin in the game for their own money, except the fees they take out and the fees they charge investors. They don't touch gold because it's too risky for them. They're more concerned about their paycheck than actually being ahead of the game for their clients. All they have to do is not manage money worse than their competition. So it's really it's kind of stay out of the basement type of dynamics in the money management industry. And so long as you don't have to be on the top floor. Of course, people like to be on the top floor, but in terms of most money managers, their business models and their paychecks are geared towards survival, and you don't do that by rowing far away from the shore, what everyone else is doing. And right now, no one in the mainstream, outside of Canada is investing in gold. I mean, you hear of a few, and I say no one. I mean, you hear of a few, aggressive, forward-thinking fund managers who are in the space, but for the most part, the mutual funds, the pension funds, the billions and billions of dollars that's managed, people who don't get on business television and tout their book because, they're basically kind of corporate money managers who, want to stay under the radar, and that's the bulk of the money that's being managed, that, they're nowhere near gold. And I think that's what Dalio's saying, that eventually the career risk will be if you don't own gold. Now, we're not there yet. We're nowhere near that, but under this new paradigm that he's talking about, he seems to be thinking that that's what will happen. And I would agree with that. I think eventually there will be a big 180-degree swing. And, certainly gold investors we've been waiting a long time for that, but we seem to be getting closer.
Should you be buying gold stocks, physical gold juniors? What would be the best bet here while the price of gold is still relatively cheap?
Well, he didn't get into that. He says he's going to do another piece and talk about gold diversification. So, I mean, we don't really follow the bullion market in terms of at Inc. in terms of its value, whether it's overvalued or undervalued. There's other specialists who try and do that. But in terms of the commodity, in terms of the stocks, insider sentiment's pretty good on them. And I think though that really at this point it's a game of betting on management that they're going to be able to find, mine if you're on the junior side, or if you're on the senior side, you got to be investing in a group of people that are competent at running these mines and, aren't going to surprise you with industrial problems and, mine plans that go off into the corn patch. I mean, so the people side of the mining business is so important. And we do try and highlight insider activity that we see, that's worth checking out, and we do put some of those on Canadian Insider for free. But of course, our subscribers get it first and get the all of our work. But following the people in the business is I think from the stock perspective more important than the day-to-day moves in the commodity. The price of gold can go up and down $10. It's not going to matter if you've got the right management team that's looking to build a mine in the right place and as are executing, the day-to-day moves in the gold price aren't going to matter.
Ted, the BC government has finally approved the building of a gold and silver mine near Vanderhoof, BC. Is that good news for the industry? Because nowadays it's pretty rare for a new mine to get approved.
Well, it takes a long time in any jurisdiction, and BC, as hostile as it is to pipelines, it doesn't have a bad record in terms of mining. There's always a environmental disapproval or issue that comes up, but that happens in any jurisdiction. So BC is may not be the most sort of laissez-faire jurisdiction for mining, but I'm not sure you want that anyways as a society. You have to have some balance, and BC's doing okay on that. And the big issue, of course, in BC is First Nation land claims and overlapping claims. So that's just probably a big of an issue as the environment. But it's good news, and it's good to see that the current government is still moving, I would say, at a good pace at approving these projects. So it's not like the current government is shutting down mine development, and even the Green Party, who is propping up the government, they're very careful not to pick on the mining industry because you can't pick on everyone, Jim. You don't want to pick a fight with everybody when you're a politician, and and I think Andrew Weaver is a pretty cunning politician. I mean, he's managed to pull off a lot, and for those who aren't familiar with him, he's the head of the Green Party in BC. I mean, he's punching way above his weight in terms of the influence they have. So he hasn't picked on the mining industry. He's saving all his dry powder and all his guns for, of course, the oil industry. That's his big target. So he's leaving the mining industry alone.
Do you wish that governments right now would spend more time on economics and promoting the economy than all these esoteric matters that they seem to be obsessed with?
Actually, no. I think the more they obsess with issues that don't matter, the better, and the more they leave the economy alone, the better. If they want to go off and study whether we should get rid of plastic bags or not, and spend all their time doing that, I think that's fine. We may end up with a stupid rule that says you can't use plastic bags or whatever. But it would be stupid, I think, because people are going to use them anyways. What are you going to do? Anyway, that's another. We could have a whole debate about that. But the fact of the matter is, it's once they start meddling in the economy and start using our money to start trying to manipulate the economy, that's when you get into problems, right? That's when you get into pouring hundreds of millions of dollars into aircraft manufacturers who then end up, selling off all their aircraft business because, they just can't really make a go of it because they can't compete. Well, why is that? Well, because the government's been backing them, so they can't really compete in an industry that's, of course, globally backed by government. So it becomes a big mess. So the more the government gets involved with the economy, Jim, I think the less they get involved. And of course, they're going to have to do something because they're all paid to go to work, and we have this big, political establishment that we've built up over the decades since World War II, and all these people go to work and they get a paycheck and they want to keep their jobs, so they all have to, make a point that they've accomplished something. So I would argue it's probably better that they would do something on something relatively minor, and maybe talk about who's going to be on the next $10 bill. That would be okay. They could spend their time doing that as opposed to trying to debase the currency with stupid monetary policies that haven't worked. But here we go. We're still talking about the Fed cutting rates again, and and of course the fallback position right now in Europe still is maybe we're going to have to go into more negative rates, but hopefully the Europeans we got some encouraging news this week that Ursula von der Leyen was elected as the EU Commission president. That's really good news because she's a German. And why is that good news? Well, because if Europe's going to start to get its act together and and provide more stimulus to the global markets. Now, one can debate what that should be or whether it should be anything, but let's just assume for a moment that if you're a stock market investor and if you're a commodity market investor, the stronger the European economy, the better it is for your investment strategy, okay? And if you have the German, which we will now have, head of the EU Commission, it's a lot harder for the German voters to complain, well, it's the French or it's the Italians who are wanting to get us to spend all this money or to support a fund that's going to make Europe more competitive. It's a little harder when there's a German at the head. So this is probably, again, we talked about this 2 weeks ago. This is probably one of the big stories to watch is a transformation of European policy going forward, because the French under Emmanuel Macron, I think, have really taken the bull by the horns here. They want to really kind of try and move Europe away from an economy that's focused on pedantic bureaucratic rules to one that basically breaks these bureaucratic rules to juice the economy so that voters are a bit happier. So it'll be done in the European way. It will not be. It'll be done by bureaucrats. The bureaucrats made all these rules. They're the ones who kind of hamstring the economy, and they'll be the ones who will be paid and will be quite happy to untangle it, because that's what they do for a living. And these rules in Europe are very, very complicated. That's one reason why the British want to leave. But just as the bureaucrats tangled the economy up in these rules, they can, if they're told to untangle it, they'll go to work and they'll start to untangle it. And that's the way bureaucrats work. They do what they're told to get their paychecks. And I think they're going to be told to start untangling some rules, spend some money, and we'll see if it pays off for Germany. But for the Canadian market, it's very important that the Europeans succeed in boosting their economic output across the board, and I think they're going to give it a good shot. So that's a very positive sign, I think, and it's one reason why we're kind of upbeat here on the Canadian market. And there's a better chance this year than last year that the Canadian market could outperform. Last year we had Fed tightening, we had a trade war increasing. Now we got trade war simmering, the Fed loosening, and now the Europeans may actually be getting ready to jolt their economy. So for Canadian stocks, it's it's looking a little brighter in the second half of this year than it did last year. Last year we were very worried, both for the Canadian market and the U.S. market. This year we're not quite as worried. Still anxious, of course. There's still a lot of warning signs out there and danger signs, but that's always the case, and there's always the wall of worry. And right now, we're a little less worried this year than we were a year ago.
We'll have more with Ted Dixon right after this.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ted Dixon. Ted, NDP, National NDP leader Jagmeet Singh and National Green Party leader Elizabeth May are both campaigning saying Europe should not ratify its free trade agreement with Canada. Do we need that kind of opposition to our economy?
Well, I hadn't heard the Green Party talk about that. Now they've got a very interesting energy policy that's being developed here, and I don't know if that has something to do with it or not. But it doesn't surprise me that the NDP are saying that, and I think the NDP are going to be nationally are at risk of basically being wiped out by the Green Party. So that'll be interesting. But I hadn't heard that story, and I'll have to take a look at what's driving it. But it doesn't really matter, because even if you get a green liberal minority government, which I think is the base case right now, given the implosion of the Conservative Party, and I'm sorry for the Conservatives who are listening, but you just have to look at the polls, and that's what's happening. And Andrew Scheer couldn't put it to bed when he couldn't put it home, couldn't drive it home when he had the opportunity in the spring, and now there's a wide gap emerging between the Liberals and the Conservatives in favor of the Liberals, and it's just remarkable. But that's a whole different story. But it is what it is. Now maybe it'll tighten as we get closer to the election. But at this point, I think one has to brace ourselves for a few more years of Liberal government, and that's not great news for the oil patch, unfortunately. Particularly, but the Green Party they're now moving to a kind of a Canada First energy policy, which will take some time to certainly get my head around, and investors would have to get their head around. But generally speaking, I think that the Liberals are very big on the European free trade agreement, and there's absolutely no way that a green liberal coalition would be able to sort of change a government's position on that. It's just too much. It's just too big of an economic trophy, and he doesn't have very many. Justin Trudeau doesn't have very many economic trophies, Jim. But the ratifying the European, getting Canada an agreement with the Europeans on the free trade is one of his accomplishments, and there's no way they're gonna let that slip away. So. I don't think it's gonna be a meaningful position by the Green Party, and the NDP just aren't going to matter nationally, I don't think, after the next election for a while.
Yes, I'm just looking at a news item. A letter has been signed by Jagmeet Singh, leader of the NDP, Elizabeth May, leader of the Green Party, and members of the Quebec National Assembly. They don't have a legislature, it's a National Assembly, saying they're against ratification of the European agreement. Do any of these people understand that Canada's a trading nation, that we need trading partners?
Well, I guess we have these people who are politically motivated and trying to drum up support amongst the base. So, I haven't seen the letter. I don't know what the thinking is, but it's a common letter, so there must be some. They got to be in their bonnet over some element of it that these people who are on a public payroll have the luxury of getting worked up about. But I don't think it's meaningful. I can't see the Europeans paying any attention to this. They're going to have their own thing, and Elizabeth May and the crowd who signed that letter do not hold enough sway, and their brand is not internationally known yet, I think, to influence it. I just can't see it moving the dial. I just think it's for domestic consumption. It's for them to talk about in the next election for their base, and I don't think it's going to have any impact.
Well, does Canada have to look more to Europe because we have Trump upping the American content for infrastructure projects? 95% American steel. How can you tell? Especially like products like steel that cross the U.S.-Canadian border several times during manufacture, exactly where it came from in the first place?
Well, that's always a tricky part in international trade, especially when you start flipping taxes and tariffs on things. But look, Jim, in Canada, why don't we get rid of our own tariff barriers in Canada? I mean, that would be a good start, and that's something we could actually control, you'd think. With a leader who has the conviction to do it, and the only one that I've heard talk about that with any conviction is Maxime Bernier, and he's not even in balanced power territory yet. So I wouldn't hold my breath for true free trade in Canada, but you never know. Maybe one of the major parties will really adopt it as a core policy. But I haven't heard certainly haven't heard the Liberals talk about it, and I haven't heard the Conservatives.
Ted, I just saw a report that said out of the G7, Canada imposes the fewest trade barriers in the G7.
No, but within itself, though.
We have trade barriers
within Canada.
Right.
Canada, right?
Like in BC, we can't have any of that fine Saskatchewan wine.
Well, right. I don't think you need a trade barrier to keep those imports down. But maybe we should get rid of them so we could actually see. But
right now, lawyers and nurses and doctors trained in one province can't practice in another. Tradespeople can't work in a neighboring province. It costs Canadians $60 billion a year because we don't have free trade between the provinces.
Exactly. So, that would be a step that we could control. But, it's not going to have, I don't think it's going to have any major investing implications because, like you said, a lot of it is in the service area. So, that when we had a massive teacher shortage, last year because of the Supreme Court ruling, it probably would have been a lot easier if we could have just snagged teachers from other parts of the country. But of course, that's not the way it worked. So, in any event, that would be a good idea if we could have some leadership in the country to get down to dismantle our own barriers. That would be good for business. It would help over the longer term. And aside from that, let's keep trying to get these as many real trade agreements done as we can. Unfortunately, most of them are very thick in regulations and tend to be managed trade as opposed to free trade. But like you said, and we talked about before, Canada is one of the freer trading nations in the world, and I think that's a positive sign, and I think that's one reason why the sort of this perpetual gloom I keep hearing about on the Canadian dollar never really maxes out. Like the currency never really collapses. I'd like to see it a little stronger than it is. I think it's still too weak. But the one reason why I think the Canadian dollar stays above 70 cents is because we are such a good, trading nation in terms of our focus. So the long-term implications for Canada are pretty good on that front, but we could even be better if we dismantled our own internal trading barriers. And you think if we could cut a deal with the Europeans, we could cut a deal with all the provinces, but apparently not.
Ted, thank you so much for chatting with us.
Well, thanks for having me back, Jim. It's a pleasure.
My guest has been Ted Dixon, CEO and co-founder of IncResearch.ca. If you have any questions for Ted or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet, our YouTube channel, Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.